As you may recall, Chapter 9 deals with liabilities. The next topic that we want to analyze and talk about is how to differentiate financing with debt versus financing with equity. Managers must decide how to get money they need to pay for assets. There are three main ways to finance operations: through retained earnings, by issuing stock, or by issuing bonds or notes payable. Each strategy has advantages and disadvantages. Finance by retained earnings means that the company has enough cash from profitable operations to purchase the needed assets. There's no need to issue more stock or to borrow money. This strategy is low risk to the company. The disadvantage is that the company growth is limited to how much it can earn. Issuing stock creates no liabilities or interest expense and is less risky to the issuing corporation. But issuing stock can be more costly. Additionally, issuing more stock may reduce the amount earned per share and may make the stock less desirable to investors. And finally, issuing bonds or notes payable does not dilute control of the corporation. It does, though, often result in higher earnings per share because the earnings on borrowed money usually exceed interest expense. But creating more debt increases the risk of the company. Bonds and notes must be paid back with cash from future earnings. Earnings per share, or EPS, is the amount of a company's net income for each share of its stock. EPS is the single most important statistic for evaluating companies because EPS is the standard measure of operating performance that applies to companies of different sizes and from different industries. Suppose a company needs $500,000 for expansion. Assume it has net income of $300,000 and $100,000 or 100,000 shares of common stock outstanding. Management is considering two financing plans. Plan 1 is to issue $500,000 of 6% bonds payable, and Plan 2 is to issue 50,000 shares of common stock for $500,000. Management believes the new cash can be invested in operations to earn income of $200,000 before interest and taxes. This table shows the earnings per share advantage of borrowing. As you can see, the company's earnings per share amount is higher if the company borrows by issuing bonds. The company earns more on the investment, $102,000, than the interest it pays on the bonds of $30,000. This is called trading on equity or using leverage. It is widely used to increase earnings per share of common stock. Also known as the equity multiplier, this ratio shows a company's total assets per dollar of stockholders' equity. A leverage ratio of exactly 1 would mean a company has no debt, because total assets would exactly equal total stockholders' equity. This condition is almost non-existent because virtually all companies have liabilities and therefore have leverage ratios in excess of 1.0. In addition to the debt ratio, analysts use a second ratio, the times interest earned ratio. This relates income to interest expense. To compute this ratio, we divide income from operations, also called operating income, by interest expense. And so this ratio measures the number of times that operating income can cover interest expense. The times interest earned ratio is also called the interest coverage ratio. A high times interest earned ratio indicates ease in paying interest expense, whereas a low value suggests difficulty. So next we want to understand other long-term liabilities. A lease is a rental agreement in which the tenant or lessee agrees to make rent payments to the property owner or lessor in exchange for use of the asset. Leasing allows the lessee to acquire the use of a needed asset without having to make a large upfront payment that purchase agreements require. Accountants distinguish between two types of leases: operating leases and capital leases. Operating leases are sometimes short-term or cancelable. However, often operating lease agreements are non-cancelable and require the lessee to commit funds to pay the lessor for use of property for years. They give the lessee the right to use the asset, but provide no continuing rights to the asset. Instead, the lessor retains the usual risk and rewards of owning the leased asset. To account for an operating lease, the lessee debits rent expense or lease expense and credits cash for the amount of the lease payment. Operating leases require the lessee to make rent payments, so an operating lease creates a liability even though that liability does not appear on the lessee's balance sheet. Businesses sometimes use capital leasing to finance the acquisition of some assets. A capital lease is a long-term, non-cancelable debt. Accounting for a capital lease is much like accounting for the purchase of an asset. The lessee enters the asset into the lessee's long-term asset accounts at the present value of the future cash outflows from the lease contract and records a long-term lease liability at the beginning of the lease term. Thus, the lessee capitalizes the asset even though the lessee may never take legal title to the asset because the lease agreement makes the lessee assume the risk and rewards of ownership of the assets and the associated obligations. So how do we distinguish a capital lease from an operating lease? FASB provides the U.S. GAAP guidelines. To be classified as a capital lease, the lease must meet one of the following criteria. The lease transfers title of the leased asset to the lessee at the end of the lease term. Thus, the lessee becomes the legal owner of the leased asset. Or, the lease contains a bargain purchase option. The lessee can be expected to purchase the leased asset and become its legal owner. Or, the lease term is 75% or more of the estimated useful life of the leased asset. The lessee uses up most of the leased asset's service potential. And finally, the present value of the lease payments is 90% or more of the market value of the leased asset. So in effect, the lease payments are the same as installment payments for the leased assets. So if any one of these four conditions are met, the lease is then accounted for as if it's a capital lease and not an operating lease. Most companies have retirement plans for their employees. A pension is employee compensation that will be received during retirement. Companies also provide post-retirement benefits such as medical insurance for retired former employees. Because employees earn these benefits by their service, the company records pension and retirement benefit expense while the employees work for the company. Pensions are one of the most complex areas of accounting. As employees earn their pensions and the company pays into the pension plan, the plan's assets grow. The obligation for future pension payments to employees also accumulates. At the end of each period, the company compares the fair market value of the assets in the retirement plans, generally cash and investments, with the plan's projected benefit obligation, which is the present value of promised future payments to retirees. If the plan's asset exceeds the projected benefit obligation, the plan is said to be overfunded. In this case, the asset and obligation amounts are to be reported only in the notes to the financial statements. However, if the projected benefit obligation or the liability exceeds plan assets, the plan is underfunded, and the company must report the excess liability amount as a long-term liability on the balance sheet. And so our last topic for this session is how to report liabilities. So this chapter began with the current liabilities reported on the balance sheet. This figure shows a standard way for a company to report its long-term liabilities, which is combined into one total exclusive of any portion that should be classified as current. It also includes a note from the financial statements. The note gives additional details about the company's liabilities. Note 10 in the example shows the interest rates and the maturity dates of long-term debt. Investors need these data to evaluate the company. The note also reports current maturities of long-term debt of $225 as a current liability and the long-term debt excluding current maturities of $2,460. And so this concludes part 2 of our review of Chapter 9. As usual, I encourage you to go back and read the chapter and then attempt the learning exercises and forward those on to your course facilitator. Thanks very much for your attention during this session. Bye.